Bitcoin is playing around in the 40,000s, keeping everyone guessing what the next move is. But it's not just because Bitcoin that some altcoin projects have seen massive price rises this year. We can see huge growth in users and adoption. Fundamental growth is also at all-time highs, and we've got some crazy data to prove it. But where do we go from here, and what are the projects that will continue to grow? Some of the altcoins in this video have risen by hundreds of % over the last 6 months. Can they continue to rise? Are they going to deliver on the hype? And what's actually happening to develop these projects into high value investments? In this video, we'll look at some of the altcoins on my watch list for this month in September. We'll see what's happening to add features and value, key dates and updates for each, plus my thoughts on these top altcoins for September 2021. And how about this key thought? Celsius Wallet. Start earning passive income on your cryptos in the app with weekly payments and get $50 of Bitcoin with your first deposit. Just use the code in the description. If you're looking for a steady coin to invest in, Link might be for you. Chainlink has added an average of 1.4 new partners every day since the beginning of 2021. Scrolling through Chainlink's Twitter feed, we can see the constant announcements of projects integrating Chainlink price feeds. One announcement stands out though, Solana. Solana has recently integrated Chainlink price feeds into their DevNet. The Chainlink team plans to integrate price feeds into the mainnet before the end of Q4 this year. This is not simply Solana integrating Chainlink price feeds though. The two teams have been working closely together for months to secure a native integration between the networks. For Solana, the integration will improve the development of DeFi apps on the network as it can leverage Chainlink's high quality and fast price feeds. For Chainlink, it will now be able to use the sub-second data it possesses from years of partnerships with providers like Coinmetrics, CryptoCompare, and many more with speed without compromising on quality and security. Chainlink doesn't only offer price feeds. Recently, it launched a partnership with Venrai, a digital asset compliance and security audit solutions company. This tool will make the lives of DeFi developers easier, as regulatory risks can be one of the biggest roadblocks in the industry. The Chainlink VRF, which is a tamper-proof randomness generator, is also being used by NFT projects ranging from crypto games to trading bots. All of these use cases for Chainlink actually makes it sound more like a tech company than a blockchain network. Although its Oracle network is decentralized, it offers services outside of this. There are fears that Link has characteristics that may lead the SEC to classifying it as a security. There's also some evidence that it won't be. Chainlink is definitely under the radar compared to networks like Solana or Cardano, but they really are the top name when it comes to providing data for blockchains, which I think is vital for many dApps. Still, Chainlink has grown 52% from last year, and I do wonder whether they'll ever announce a link with Cardano. Maybe we can watch this space. Next up, the current king of altcoins, Ethereum. ETH is sitting at a key level right now, at a nearly 400 billion market cap. Where can the value go from here? Some say that ETH can flip Bitcoin in this bull run. That seems like a tall tale, but who knows? The key driver for Ethereum now is the launch of ETH 2.0. We've already seen how much value EIP 1559 has added for ETH. That upgrade was, by all metrics, a huge success. The actual upgrade went without a hitch, and any thoughts of a possible miners' revolt didn't materialize. Since the upgrade, an incredible $400 million or so of ETH has been burned. ETH tokens that would usually have been put into circulation, diluting supply, have been permanently removed. If anything, the rate of burn seems to be increasing even higher, as you can see right here. This is also linked to Ethereum gas fees, which have been rising a lot over recent days and weeks, along with completely insane NFT trading figures. NFT platforms like OpenSea are built on top of Ethereum, and users need ETH to pay for NFTs and the fees associated with transactions. It's obviously not sustainable to continually have higher fees and a higher price of Ethereum. That won't sustain the network long term, and fees have to come down, which is going to be addressed with the launch of ETH 2.0. That will introduce sharding to the network along with proof of stake. These should reduce network congestion, increase scale, and therefore reduce fees. To that end, we can see the Ethereum Foundation has secured about 1.5 million in donations for system upgrades. 6 crypto entities, including Kraken, Uniswap, and The Graph, have invested and will help with ETH 2.0 development. That's major backing from big industry players and a big vote of confidence in the launch of ETH 2.0. The ETH 2.0 contract on Ethereum has now become the single largest contract on the ecosystem, valued at over 22 billion by now. That's over 7 million investors locked up until the launch. This will only increase as we get nearer to the possible launch of ETH 2.0 towards the end of this year, but probably sometime early next year. Rewards are currently sitting at around 4% as an APY, but this will reduce over time as more people stake and those rewards are shared out over more stakers. ETH is already valued at 400 billion, so we can't expect those fast 5x gains in my opinion, but that's what investing in large projects is about. With size and status comes a reduction in investment risk, and that's why investors pay more for standout assets. Get this though, with ETH 2.0 sitting at 22 billion staked, it actually sits third in the rankings behind Solana with 26 billion and the big daddy of proof of stake, Cardano, with a huge 63 billion worth of ADA staked on the Cardano blockchain. With so many growth drivers in the industry in general, like NFT demand, pay-to-play games like Axie Infinity, and even large multinationals like Visa and even Budweiser buying the beer.eth domain, all currently built on Ethereum. And with the move to ETH 2.0, I somehow feel like this is only the start for Ethereum, even now. Next on my watch list, and consistently on my watch list, Cardano ADA. Here's what we know for this month. September 12th is the official launch for smart contracts, which has been confirmed a number of times by Charles Hoskinson. Have you missed the boat on this investment if you hadn't bought in this year when ADA was well under $1? Well, yes and no. Yes, you've missed the smart contracts trade. That's been and gone. Now your trade will be the ecosystem trade. If you think Cardano can build out an ecosystem of NFTs, dApps and DEXs, just like Ethereum, then over the next 2 to 5 years, we should see ADA justify its position as a top 3 blockchain. If you want to find out more on the dApp ecosystem and the new projects and dApps that will launch on Cardano, then definitely check out my latest updates video that goes through a few top projects launching soon. And definitely subscribe to the channel for regular Cardano updates. Something to watch out for during September onwards, and a really key bit of data to understand, is the blockchain's transaction data. If we see transactions growing even higher, it's a huge sign that people are starting to use the platform, and that's only good for the price of ADA. A good example of a possible project on Cardano is called Milkomeda. I go over this in more detail in my latest Cardano update video, but in short, Milkomeda wants to create a cross-chain bridge between Cardano and Ethereum, potentially linking the two blockchains. That means that Ethereum dApps may have an easy way to launch on Cardano too, so that ADA holders and people in the Cardano ecosystem could use the dApps that currently run on the Ethereum blockchain. It could open up huge value for both Ethereum and Cardano developers who may be able to launch their dApps on both ecosystems. To pay for fees on Milkomeda, you'll need Wrapped ADA, which I assume to be an Ethereum-based ERC20 token. In fact, the Milkomeda team say you can still stake Wrapped ADA to earn staking rewards on Cardano, which is great news. A protocol like Milkomeda could potentially see the ADA ecosystem grow really fast. Rather than waiting for developers to build out an entire ecosystem from scratch, like Ethereum had to do, Cardano has the benefit of launching after that ecosystem, meaning potentially that the flow of capital could happen even easier and quicker than we saw with Ethereum's growth. The potential fundamental growth of Cardano is something I'll be watching closely over the next few years. Next coin, Solana. Solana has been tearing it up in recent weeks. Even with a slight softening of crypto asset prices recently, Sol has been blasting through all-time highs, $50 a coin, $75 a coin, and recently it sailed through $100 a coin without a pause. Why has it done this, and how can we now invest in Solana? Well, the Sol price rise isn't hype, at least not 100% hype, but due to the blockchain user and transaction growth. How much this will continue and where the Sol price will find resistance, nobody can predict, but here are some value drivers for Solana. Firstly, Chainlink has tied up with Solana to bring decentralized data feeds for Sol, as we mentioned earlier in this video. Chainlink is the #1 blockchain data provider, and this can open up huge new avenues for Sol developers to make dApps, DEXs, and other projects, or just improve their current projects. Great news for Solana. There seems to be a growth in institutional interest in Solana also, which may explain a chunk of the price rises. As investors, we cannot predict prices, but as Solana has now processed almost 26 billion transactions and is attracting more projects, it does make sense that the market cap rises as well. Not just DeFi though, but also some increasingly big NFT launches are going on right now on Solana, with the Degan Ape launch seemingly coinciding with a massive Solana price rise. If NFTs are popular, more Sol is needed to buy them, so it makes sense. Difficult to tell though if this will continue or whether we'll see some sort of deflation at some point if and when the NFT market gets a little bit of the hot air knocked out. Solana employs some novel techniques to increase transaction throughput, which can basically be summed up as ridiculously fast block times. As we know, if you increase block time, you end up with potentially hundreds of terabytes of data per year that need to be stored by validators. End result is high cost and high centralization. Not that great. Solana gets around this by only storing 2 days worth of transaction data on validator nodes, and it passes the rest of the data to a blockchain storage provider called Arweave. Yeah, just one provider for the moment. These are the compromises that Sol must make to provide such a blazing fast base layer, but precisely because of this, it is carving out a niche in the market for certain projects and could continue to do so with, up until now, what looks like competitive fundamentals in total value locked and with users. Next up is Luna, the token of the Terra network, which has a different goal from most altcoins. Instead of trying to build an ecosystem of dApps, it wants to create a network of stablecoins being widely used for online payments. The Terra white paper's proposed problem is that Bitcoin's price fluctuation is a huge roadblock on the cryptocurrency's adoption. Nobody wants to pay with a currency that has the potential to double or halve in value in a few days. It's quite safe to say that Bitcoin is seen more as a payments remittance network and the coins as a long-term inflation hedge. The goal of Terra's system though is to match each stablecoin with their currency counterpart. Terra USD, or otherwise known as UST, must always match the US dollar, and Terra KRW or KRT must always match the Korean won, and so on. Here's a summary of how they maintain prices of those stablecoins under the hood. The price of UST, for example, depends on its supply and demand. If the demand for UST increases, which in effect will increase the price, Luna will be swapped for UST, increasing UST's supply and maintaining its price at $1. If the demand for UST decreases, USTs will be swapped for Luna, decreasing the supply of UST and maintaining the price at $1. If you stake Luna, you can get rewards based on this mechanism as well. Basically, an investment in Luna is an investment in the continued adoption of UST and the other Terra stablecoins. Obviously, we can't judge the network based on the price of UST because it's going to be pegged at around $1. However, an increase in a stablecoin's demand means it needs more supply or else it won't be stable anymore. And the market cap of UST shows a decent rising demand over the past year as the market cap is growing. That means there's more coins compared to before. Although it seems like Luna's success is really only tied with more adoption of Terra stablecoins, in July of this year, Arrington Capital, Pantera Capital, Galaxy Digital, and Block Tower Capital also committed $150 million to Terraform Labs. That's the company behind the Terra network, and they're going to be using that for developing the DeFi ecosystem. Terra network is also awaiting a huge update called the Columbus 5 upgrade. It will enable more applications to be built on the network and create more financial incentives for stakers. This is promising for the network because its whole mechanism relies on rewarding Luna and stablecoin swaps. Anchor is the biggest use for UST right now for investors. You can deposit your USTs for around about a 20% annual yield. Just go to anchorprotocol.com to find out more. Last up is Polygon. I'm still trying to figure out how this crypto will fare once ETH 2.0 launches. The Polygon Hermes merger is the first full-blown merger of one blockchain network into another. Polygon's acquisition of Hermes for 250 million USD is a step to implement ZK or zero knowledge rollups in Polygon. A rollup is a way to take transactions off chain and then process them all at once on the base layer. This will make transactions faster and fees lower. This makes Polygon probably the #1 scaling ecosystem for ETH right now. Transaction data from Polygon shows that we're ranging from about 4 to 7 million transactions per day in the last 3 months. It's very impressive. However, the inflation rate for MATIC, that's the token of Polygon, sits at around 18.75%. That is high, so certainly get staking your coins if you have them. Current staking rates are around 13%, so that takes away a lot of the inflation. Polygon is also not the only layer 2 solution trying to solve Ethereum's scalability problem. One of Polygon's competitors is optimistic Ethereum. Instead of creating its own blockchain like Polygon did, it decided to create an application inside Ethereum's blockchain that they claim executes transactions more efficiently than Ethereum itself. We would hope so. This begs the question, where will the cards fall when ETH 2.0 launches? Vitalik Buterin said in an interview that there will still be room for everyone after ETH 2.0, meaning they will still need the help of layer 2s like Polygon and Optimistic. We don't know how much current demand will change though. ETH 2.0 will introduce sharding, which is a scaling solution that will divide the network into 64 chains. This will divide the work and decongest the network, exactly what Polygon is already doing on its own. Sharding will increase the TPS, or transactions per second, of Ethereum from 15 now to about 3,000. Rollups, however, can potentially increase Ethereum's TPS to 100,000 per second. Vitalik Buterin said, if you have rollups, but you do not have sharding, you still have 100x factor scaling. So sharding will just be increasing the transactions per second that layer 2 rollups will multiply. Key takeaway from what I just said is that Vitalik Buterin prefers ZK rollups, and if Polygon are the leading provider of them, then long term they could continue to see growth as a platform. In conclusion, I have noticed a trend over the last few months of actual projects being bid up. What I mean by that is we have coins like Luna and Sol gaining huge ground with their market cap, but also gaining in comparison to other coins, especially meme coins. Those coins shot up the rankings during the last kind of crazy bull run, but what looks to be happening now seems like projects with development schedules and white papers are adding value. That's not to say that memes can't come back at some point, but people that have been in the investing game for a while will usually tell you that at some point sooner or later, fundamental value usually wins out. The adoption catalysts are clear. We're seeing uptake in crypto and blockchain tech, and we all know the benefits of lower cost, faster and decentralized systems. But the main risks I see right now are some sort of pop to the NFT hype and, as always, potential regulation. If you want to see how that all plays out, definitely subscribe for more. Definitely also have a look at Celsius Wallet. If you hold Bitcoin or stablecoins, you can get paid interest on your holdings. Currently you get 6.2% on your first Bitcoin and 8.88% interest on many USD stablecoins in the app. Use the link in the description to get $50 of Bitcoin with your first deposit.